So in this video, I will provide a wrap-up of this chapter, and I will also visualize some testable aspects. So the reading covers 5 main insurance products, and throughout this chapter we have covered life insurance, annuities, pension plans, property and casualty insurance, and the reading also mentions about health insurance in a few sentences, so I would give it a mention in this video. And from a testability perspective, an important takeaway is to understand the major risk associated with these products. In the case of life insurance, the major risk is mortality risk, meaning to die sooner than predicted in mortality tables. In the case of annuities and pension plans, the major risk is longevity risk, meaning to die later than predicted by mortality tables. And needless to say that mortality risk can arise from events such as wars or epidemics. And in contrast, longevity risk is mainly driven by advances in medicine or improved nutrition. In the case of property and casualty insurance, the major risk is natural disaster risk. And in the case of health insurance, the key risk is morbidity risk, meaning the risk of illness or disease. And I know I'm repeating myself, but from an exam perspective, it's important to understand how these products are positioned along the mortality and longevity risk spectrum. And to reiterate the previous in a visual manner, life insurance is mainly exposed to mortality risk, while pension plans and annuities are exposed to longevity risk. Another testable aspect is how the premiums are adjusted across products, and for life insurance, premiums are typically fixed, meaning that the insurer cannot increase them later. And on the other end of the spectrum, we can see property and casualty insurance and health insurance between the two. In the case of property and casualty insurance, adjustments are risk-based, meaning that the insurer can raise premiums because the risk profile deteriorated. On the other hand, in the case of health insurance, the adjustment is cost-based, meaning that the insurer can only raise premiums because the overall cost went up and not because someone subsequently developed some serious disease.